Welcome back, everyone. Today on the Joseph Carlson Show, Warren Buffett's Berkshire Hathaway just bought a lot of TSM. Jeff Bezos is basically predicting that there's going to be a very bad recession in the next year. We're going to listen to his remarks. And Barry Diller came out and talked about all different media companies. And he talked about Netflix. He says Netflix already won, and he explains why. And we've had the earnings results of Walmart and Target. Walmart's doing really well, Target's doing really poorly, and we're going to try to contrast with the numbers why Walmart is outperforming Target. So as always, we have a lot to get into in this episode, a lot of news to cover, and of course we have a portfolio update. Now, before we even start off with my portfolio update, I want to do a quick update on the episode I did last week, the total catastrophe with FTX. This episode in particular, that was released last Sunday, I think was a pretty negative episode. I was very bummed at that point in time. FTX did all sorts of fraud with their international business. They declared bankruptcy. The bankruptcy washed over into their US business, and the brokerage accounts on FTX US were also taken down. So I came out with this video addressing this whole issue, but I have a lot of updates since then. A lot of good things have unfolded over just the past 5 days. After that video was released on the 13th, a company called Embed sent me an email on the 15th. The email contained a link to go to an account recovery portal. The account recovery portal had a bunch of instructions on how to get back to your account. It took about 2 minutes to follow those instructions, and then boom, I have reunited back with my account and the full assets. Now, not only does this have my current account balance, but it had everything. My order history, funding history, all of my legal statements, all the information was on the Embed account. It instructed me that all I had to do at this point was connect a funding source. Once I connect my bank account, it'll automatically withdraw the money back to my bank account. And that's exactly what happened. Once I connected my bank account, the money was back in my account the very next day. All the cash, all the stocks, everything I had on FTX's stock brokerage was back in my own bank account on November 16th. Now, of course, I was happy to see this process work out so quickly. And it didn't just work for me. Anybody that bought stock on FTX US was able to get their money back. I confirmed this with multiple people. That was much quicker than I expected. And to me, that reflects very positively on the entire financial system in the US in general. The regulated portions of FTX did work as normal. The part that's having issue is the cryptocurrency portion. The people that purchase cryptocurrency may still be in limbo. They may have to wait a long time to get their full assets or even part of their assets returned. But the people that purchase stock got all of their assets back right away. The heavily regulated portions of the investing industry are so much more trustworthy, and that's what I'm going to be sticking with for all of my investments and future investments. Another thing I was concerned about last week with the fallout of FTX's stock brokerage was M1 Finance. Is our money really safe on these fintech platforms? Well, with how quickly I was able to retrieve my funds from FTX's stock brokerage, only 6 days after it goes under, I had a full retrieval of funds. I think that speaks a lot more positively for other platforms like Robinhood, M1 Finance, Wealthfront, and SoFi. The system worked really well with the regulated portions of FTX, which is the stocks. It's only having real trouble with the unregulated portions. And I think this speaks very positively about these other platforms. I frankly feel a lot more confident after this week, seeing the process play out, using a platform like M1 Finance, one that's located in the US and is part of FINRA and SIPC. So I think that's an important update of what's transpired over the past 7 days. A lot has happened, and it's been very encouraging. I feel a lot better, not only about the FTX situation and people that signed up for the brokerage being able to get their assets back, but also about the entire financial system in general. I saw the regulations work in real time and actually really efficiently. Now, another thing I think is worth mentioning on this subject is I was able to talk to Brian Barnes yesterday. He is the founder and CEO of M1 Finance. And I asked him a lot about the entire FTX situation, what Sam Bankman-Fried did, his thoughts on regulations, what M1 Finance and other companies like Robinhood and Wealthfront do to protect your assets, the difference between regulations in the US and international, and anything regarding this subject. So if you're interested in this entire subject, I would check out that interview. I'll leave a link in the pinned comment below. So having said all of that, after this week, I do have a renewed confidence in the entire system as a whole. And I'm going to be using M1 Finance as normal going forward. I do trust the platform. I have nearly all of my assets on it. I have 2 different accounts with a lot of money, around $400,000 plus on this platform, and I'm going to continue funding it like normal. I plan on putting my Roth IRA on Schwab, but I do still plan on using M1 Finance for the huge majority of my investments. Now, moving on from all of that, I do want to give an update from the portfolio itself. We have the passive income portfolio, which is now at $372,000. We've had some decent gains over the past month. We're up to $40,000 in the green, 17,000 of which is dividends. So around half the total gains since the start of this portfolio is dividends, which makes sense because if you look at the total stock market, over the past 100 years, around half the total gains come from dividends. Dividends make up a huge part of total returns from the stock market. There's a lot of people that really aren't fans of dividends. They say that they'd rather focus on hyper growth companies and look for companies that have rapid capital appreciation. And I think that's a fine strategy, but I do want to emphasize how big of a portion of gains come from dividends. In 2018, I only made a couple $100 from dividends. And at that point in time, companies were paying me only a few pennies, maybe 30 or 40 cents per quarter. So it doesn't feel like a whole lot comes from dividends when you're only receiving that amount of money. But as you grow a portfolio, it does become meaningful over time. $17,000 now in dividends is a very significant amount of money in general, but also it's been snowballing. It's increasing dramatically year over year. The dividends I'm getting paid now are not small. They're not a few pennies. Starbucks is paying me $333 on November 25th. That's 1/4 of dividends. They pay me this 4 times a year. So whether or not Starbucks goes up or down a little bit, I have this cash flow coming in all the time. Church & Dwight's going to pay me $40 December 1st. Microsoft will pay me $105. Target's going to pay me $42 December 10th. And this chart will populate with more upcoming dividends as more companies declare them. This continuous flow of cash into my stock brokerage from dividends themselves has been an instrumental part of the compounding snowball. Not only do I have $17,000 in returns from the dividends, but all of this has been reinvested, buying me more shares, buying me greater dividend payments in the future. So we'll see what happens in the future. If the market takes off and goes up like crazy, then my market gains, my capital gains will outpace my dividends. If the market continues to go down in this bear market, then my dividends will outpace the capital gains. Either way, I'm earning a return. Either way, I'm compounding. The market can go up, it can go down. My portfolio is going to become more powerful at the end of the day. Now, moving on, we have some huge news. Warren Buffett bought a new company, and he actually paid a lot for it. This instantly moved a non-holding, something that he didn't even own a little bit of, to a top 10 position. That's not something we see too often, so this is actually a very important buy by Buffett. To put this in perspective, we can look at Berkshire's portfolio here. He has the huge concentration in Apple with 41% of his portfolio. Now, don't get this confused. This isn't 41% of Berkshire, because a lot of what Berkshire owns is privately held. This is 41% of its publicly held portfolio. But Apple is by far their largest concentrated position in their public portfolio. Then we have the banks, the oil companies. Then we get to number 10 right here, which is TSM, a 1.39% position. That may seem small if you're looking at your portfolio, but when you're looking at Berkshire's, that's $4.1 billion. That's a massive investment. Now, when we look at why Berkshire would buy TSM, the more you study it, the more it makes sense. We can go through a little bit of background here. For years, Berkshire mostly avoided technology stocks. In fact, in Berkshire's 2008 annual report, Mr. Buffett went so far as to say that he preferred simple businesses. If there's a lot of technology, we won't understand it. So in 2008, Buffett's giving explanation of why he doesn't buy tech stocks. But then 3 years later, he starts buying tech stocks. In 2011, Berkshire bought $10.7 billion worth of IBM. This was an ill-fated bet that they exited in 2018, and I'll add, at a substantial loss. Berkshire did lose a good amount of money on that bet, which I think is important to keep in mind. Buffett doesn't get every single investment correct, but the ones that he does get correct, he gets them correct for a long period of time. But even after making a mistake with IBM and losing money on that, they didn't quit with tech altogether. They bought Apple. Then they purchased $1 billion of Amazon. Then earlier this year, they purchased HP. Now, I think out of all of these buys, I think Apple is by far their best one. I think it's the best buy that Buffett has done for the past 20 years. And I think it will continue to probably give the best and most significant gains for the company. But regardless, he is going in and buying a lot of tech companies now. And ironically, one thing that I'll just point out here about Buffett and Munger, these two incredibly old and wise individuals, is a lot of people look at them as not the experts on tech. What do they know about new technology when they're this old? They can't possibly understand it. Buffett has made more money on tech investments than companies like Tiger Global that have been clobbered over the past year, or Cathie Wood that have been clobbered over the past year. There's so many tech investors that haven't done as well in tech as Warren Buffett. So when I look at the actual returns here, they speak for themselves. Warren Buffett is a tech investor, and his tech investments have done really well. So him going in and buying a new tech company is something that I absolutely pay attention to. He purchased nearly 60 million shares of the company, again at that $4.1 billion price point. That's a lot of money even for Berkshire. A spokesperson for TSM said that they welcome all investors with the propensity to buy and hold TSM stock. Very generic statement, but in my opinion, if I owned a business and I received an investment from Warren Buffett, I don't know what other validation could possibly be better. That is getting the stamp of approval from the best investor that's lived on planet Earth. So I think TSM should be very happy with a Warren Buffett investment. It speaks very positively about the future of the company. Now, like most of Warren Buffett's initial investments, he buys them on a dip. The timing of Berkshire's investment is notable. The semiconductor industry has faced a reckoning this year after enjoying a surge in profits during the pandemic. Chipmaker companies have cut costs, reduced output, and reined in near-term capital spending plans because of the slumping demand. So the stock price has actually moved down significantly over the past year. It's down around 47%. Then Warren Buffett buys a stake in the company, discloses his holding, and the entire industry had a pretty good bounce. It's up 30.5% from its lows. But overall, if you look at the long-term history, Buffett did buy this company still at a significant dip. Now, why would Warren Buffett specifically choose TSM out of all the different chip makers? Why not AMD? Why not Nvidia? Why not Intel? Why TSM? TSMC is also a key provider of chips to Apple. Mr. Buffett has described the iPhone maker as Berkshire's second most important business, following its insurance business. Buffett doesn't look at Apple as a stock. He doesn't look at it as just a come and go investment. He looks at it as a cornerstone, a pillar of Berkshire Hathaway, part of their overall empire, and something that he wants to own going forward for decades, like he's owned Geico, like he's owned Coca-Cola. It's part of the Berkshire house. And it really doesn't take a lot of detective work to see how TSM is linked with Apple. Who manufactures Apple chips? TSMC. So this is a pretty easy equation. If Apple thrives over the next 10 years, if it continues to do really well as a company, other companies that benefit from Apple thriving will also thrive. And TSM is one of the primary companies that will benefit from Apple doing well. It's basically an extension of Apple itself. They work hand in hand. Apple doesn't own TSM, but TSM plays an important role in Apple's business. And I think Buffett views this as owning basically more of the Apple ecosystem, more of the entire process. He's vertically integrating his investment in Apple, the entire supply chain and manufacturing chain. Now, the analysts say there's a school of thought that believes we're close to the bottom for chip stocks. So the analysts are focusing on the price point. Saying the stock has traded down and Buffett's buying the dip, I think that's correct, but I again think that misses the bigger picture. I don't think Buffett's looking at TSM as just buying the dip in some random stock. I really think he's looking at the overall picture and the ecosystem with Apple. Now, another thing to consider with this investment is the relationship between TSM, China, and the US. It's a pretty complicated relationship. China has some tensions with both the US and Taiwan, considering it part of their territory. And there's many people that think that China will eventually invade Taiwan. If that happens, of course, that will dramatically affect the investment. Now, there's different opinions on this subject. There's different geopolitical experts on it. I can't say if this type of thing will unfold. My opinion, I think it's unlikely, but I do think if it did happen, it would be complete chaos, both between Taiwan and China, but also between the US and China. The US has stated that we won't allow China to invade Taiwan. So that would spark an international tension, I think, greater than what's happening in Ukraine. Now, on that front, with all the politics involved with China, TSM is geographically diversifying their business. They say that they have plans to expand existing factories in Japan, building multiple plants in the US, as well as potentially in Singapore. The factories in Japan and the US are obviously more isolated and protected. So here's a couple takeaways from this news of Berkshire buying TSM. First of all, Buffett is a great tech investor. That is in the numbers. He has better investing returns with his tech investments than most tech funds that pore over and study specifically tech companies. Buffett has outperformed the majority of them by just identifying one business called Apple. This tech investment has held up better than any of big tech over the past couple of years, and it's given him tremendous returns over the past 5 years. The next thing is that I think the analysts are wrong in implying that the buy into TSM is simply because it's on a big dip and he wants to just buy a company that's on a dip. I don't think that's the reason he's buying it. I think that he's buying it both because it's on a dip, but also to expand and vertically integrate his investment into Apple. I think he thinks that TSM is basically an extension of Apple. And since he's so bullish on Apple, he's bullish on this company by consequence. So I think there's a greater picture here with an entire ecosystem bet, and I actually think this is a great buy from Buffett. One of the best recent buys that I've seen him do. Now next up we have this interview with Jeff Bezos, which he doesn't do that frequently, so I like to highlight them when they do occur. But this one he gave a startling prediction, something that many people have been worried about, but Jeff Bezos is even more concerned about this: the direction of the economy. He's asked specifically, what is your advice for small business owners right now?
I don't know whether we're technically in a recession. I know economists argue over that and they have certain technical definitions. What I can tell you is the economy does not look great right now. Things are slowing down. You're seeing layoffs in many sectors of the economy. People are slowing down. The probabilities say if we're not in a recession right now, we're likely to be in one very soon. So my advice to people, whether they're small business owners or, is take some risk off the table. If you were going to make a purchase, maybe slow down that purchase a little bit. Keep some dry powder on hand and wait a bit and see how. Try to reduce some risk in your business or your life.
To me, I think this is good advice. And coming from someone like Jeff Bezos, I do think he has a very good insight into the economy overall, maybe better than the Fed, maybe better than the White House, maybe better than most economists. Because Jeff Bezos has Amazon. Imagine the analytics that company has and their projections of the future. Amazon both has its massive retail business, which they can gauge consumer behavior, trends and patterns with purchases, whether people are buying expensive items or cheap items, but they also have AWS, and they can see if tech companies or companies overall using digital assets are slowing down their spend. So he has two massive businesses, two of the biggest businesses in the US that give him an insight into the future of the economy. And then Amazon also has an edge with its secret squad of PhD economists. So they're basically like the Fed with a bunch of economists poring over this data. So I don't think this is just him giving his hunch, his just random opinion. He's not doing this based off of no data. Everything that Jeff Bezos has done for the past 20 years has been analytically based, objectively based. And I think when he gives warnings about the economy slowing down, when he says now it's a good time to take risk off the table, to raise a little cash in both your business and your personal life, it's something that I pay attention to. If you don't have a savings right now, I think it's a good time to start. Now, next up, we have this interview with Diller. He's a big broadcasting and media guy. He's worked in the industry his entire life, and I really like his interviews and insights on this subject. So here he is giving his opinion on multiple media companies and streaming companies. The first one that he's asked about is Netflix.
What about Netflix?
Netflix won. Get over it.
Netflix won. Get over it.
Of course. Netflix will never be displaced as the leader in streaming.
Will other players be able to make money in streaming?
No.
So a few things right there. He definitively says that Netflix won, get over it, and that no one else is going to make money in streaming. I don't know if I fully agree with both of those statements. I do think that Netflix won. I agree with him on that. And by won, I mean Netflix is at the biggest scale and profitable. It's already the leader in streaming. I think it's won that race. I think other companies might be able to combine and they might do acquisitions and grow through acquisitions. But in terms of a pure play streaming player growing as big and bigger than Netflix, I don't think it's going to happen. So I do agree with him on that.
I don't think so. I mean,
Netflix goes from 800 to 200. That doesn't feel like a win.
This is something that's common in investing. Netflix did go down in price a lot. We look at the stock chart there. It went from $600, $700 down to $200. So with the huge fall in stock price, Joe Kernan says that Netflix must not be winning because the stock went down. The stock falls, and therefore people think the company's doing poorly. This is specifically what you're not supposed to do in investing, equating the stock price of a company with the fundamentals of the company. Stock prices vary from the fundamentals dramatically, and they do it frequently. Every year, a stock may trade around 50% from its fair value. Stock prices are very volatile, even when the fundamentals of the business are very solid. Here's what Netflix's total subscriber count looks like since the beginning. Does that look too disastrous to you? Doesn't look too bad to me. It looks like most things are on track. Here's what Netflix's monthly revenue per user looks like over time, a steady trend upwards. Here's what the monthly active churn rate looks like per streaming platform. This is the amount of subscriber base that cancels the streaming service per month. Netflix again is leading the pack with the lowest churn rate. So let's listen again to what Joe Kernan says here.
I don't think so. I mean,
Netflix goes from 800 to 200. That doesn't feel like a win.
But if you ask Joe, what objective metric is Netflix actually losing at in streaming, he wouldn't be able to come up with an answer. The only answer given is the stock price went down.
Well, you're doing it, again, you're doing it on the momentary equity. But the truth is if you say who leads streaming, it is Netflix.
Right.
And I love that Barry Diller calls him out on that, saying that he's focusing on the momentary equity pricing, not the actual company itself.
It will continue to lead streaming, and eventually they'll pare their costs down. Look, they shot their costs up in order to build their business, and so they put a lot of money in programs.
So I agree with Barry Diller here. I do think that Netflix is in the best position. That's why I hold Netflix stock in my growth portfolio. But I'm still bullish on other streaming companies. I'm bullish on Amazon Prime's aspect of their company and Disney Plus. I think those will both do really well. Now, Barry goes on to explain that basically what these streaming companies are doing is throwing so much money at streaming that at a certain point, it's completely unsustainable. Netflix was able to get away with this for a long period of time. They were able to work with a free cash flow negative profile for year after year after year. In fact, if you look at the free cash flows of Netflix, from 2013 to 2019, the company literally lost more and more money every single year. While the stock was going up, investors rewarded them for losing cash flows because investors saw this light at the end of the tunnel of them reaching scale and the cash flows turning positive. The question is, can other companies get away with this? All of them are trying to catch up to Netflix now by doing the same strategy Netflix did over the past 5 years, throwing a ton of money at streaming. And this is costing these companies a fortune, Disney being one of them. Disney's free cash flows are in the gutter, and this is mostly a result of streaming. They've lost $8 billion in Disney Plus alone since the beginning of that service. Warner Brothers Discovery has huge cash flow issues as well as they're reconfiguring their business for streaming. It's a very expensive thing to do. Even though they have all of these legacy media properties trying to fund it, it's still incredibly expensive and it's hurting their earnings. Paramount Plus has the same thing. Cash flows, generally speaking, are going down, especially recently, as the company pours more money to fund their streaming business. Their streaming portion of the company is free cash flow negative right now and will continue to be for potential years. And what's the name of the game here? To spend, spend, and spend trying to catch Netflix.
All of them are drunkenly spending money in order to establish market, in order to do this. But at some point, you've got to reconcile the money they've given up in linear television, which was huge, to transfer over to a new scheme of direct-to-consumer, which when you can balance it out, less program. The result is going to be less programming.
This was an interesting statement. He says that the result of moving from linear television to streaming is less programming, not more. That's where I disagree with Barry Diller. I think temporarily it'll be less programming as these companies realize that they don't have the budget to throw endless amounts of cash into streaming like Netflix did for the past 10 years. But I think overall in the future, 10 years from now, I think the amount of programming we'll have is multiples higher. And I think that because the economics of streaming overall, I think will prove to be better. When Netflix and other streaming companies get to global demand and huge scale, I think they'll have a bigger budget because of their larger subscriber base and larger reach. Everybody on their iPhone, tablet, TVs, every single portable device can watch streaming where linear television was only in your house on a television. So the capabilities of streaming reach more people means more funding means more programming. Now, another part that I thought was interesting is his thoughts on valuations. He was asked specifically about the valuation of Netflix a year ago and the valuation now.
But what happens?
At some point.
Where was the market right? And the valuations where it was being valued $800 for Netflix or down
well,
here
all
at
those
200?
valuations, lots of those valuations were crazy.
He says the valuation for Netflix was crazy a year ago, but lots of valuations for lots of companies were crazy.
But is it crazy down here too?
Yeah, long term, probably so.
But then he also thinks the valuation right now is also crazy looking at the long term. And I think he's probably correct. The market likes swinging prices too far to one side and the other. And I think looking back 10 years from now, we'll say that right now is a good time to buy streaming companies. Now, moving on, we have some news about the two different retailers both reporting their earnings and having wildly different results, Walmart and Target. Their quarterly results were very stark. Walmart's doing well, giving good guidance, having good earnings. Target is disappointing to a large extent and giving poor guidance and giving some troubling news about a development that I really wasn't aware of at Target's business to this extent. I know that every retailer has a level of theft they have to deal with. Unfortunately, there's criminals that like to take whatever they can for free. But in this case, the amount of theft that's happening at Target specifically is really troubling. In the earnings call, the executives blame criminal networks for thefts and inventory shortages in their stores. They said Wednesday that they expected the shortages to reduce the retailer's gross margins by more than $600 million this year compared with last year. $600 million. They said in total goods, there's well over 400 million being stolen out of their stores by criminals. People walking in and just taking whatever they want and leaving. That's a substantial amount of money being stolen, but the more troubling thing is also the trend. This problem is getting worse, not better. Quote, along with other retailers, we've seen a significant increase in the theft and organized retail crime across our industry. A Target spokesperson said that retail crime incidents at Target were up 50% from just a year ago. Now, of course, I don't want to victim blame here. Stealing and theft is always immoral and a crime, and the people that do it hopefully go to jail. But Target, of course, is a business that knows that this is a threat, and they play a role as a retailer in protecting their merchandise and making sure they have ways that criminals are not successful. What I do know about retail is that the messier the store, the more likelihood there's going to be theft. The more organized, the more clean the store is, the more employees there, the less theft there's going to be. And there's posts like this on Reddit from people complaining that Target stores are a total mess right now. Is anyone's store not a total mess? This employee goes on explaining about how messy and unorganized all of the stores are. Everybody posting about this is a big problem at Target. There's other Target employees saying that almost every Target is a complete mess, with pallets, merchandise, boxes on the sales floor, OSHA violations, and so on and so forth. And there's comment after comment saying the same thing, how messy their stores are and how unorganized their stores are. So again, while I blame the criminals, ultimately, they're the ones responsible for doing this, and hopefully they get caught and thrown in jail, I also think there's some responsibility that relies with the executive team, the management of the stores, and the protocols that they're using. They're in the business of selling merchandise. They know that crime is a problem. And if they're running their stores in not an efficient and clean manner, the amount of shrinkage from these stores, the amount of items that go missing is going to be a big problem. And this is part of the reason why you don't see this problem at Costco. Costco stores are clean. The entrances are small. There's employees watching both the entrance and the exit, and they check receipts and look at your cart as they exit. And as a consequence, the amount of merchandise lost at Costco is the lowest in the industry by a huge margin. And that's not because criminals are less of a criminal when it comes to Costco compared to Target. It's because Costco does specific things to prevent criminal activity. Now, Target says that they're investing in technology and training to deter theft, and this is what Home Depot has done. They said that it's helped, so hopefully in the future they can get a better handle on this. So that's one impact on Target's earnings reports. The theft is not helping, it's actually dragging down the stock. But I think there's a bigger reason why Walmart is outperforming Target, and it has to do with pricing. Everyone knows that Walmart is cheaper than Target. The Target slogan by many people is pay a little extra to not shop at Walmart. But with inflation and budgets getting tight, a lot of people are saying, you know what? I'll deal with Walmart. I'll deal with the metal carts. I'll deal with the traffic in the store. I'll deal with all of it because it's cheaper than Target. And if you actually want to see how much cheaper Walmart is than Target, we can see that in the numbers, their actual reports. If we go down, we can look at one metric here, the ratios. We can uncross that and look at the profit margins here. This is the thing that we'd look at to determine how much they're really charging customers. We look at Walmart's profit margins, and over the past 3 years, it's been anywhere from 3% to 2%. Costco, for example, has about a 2% profit margin. So Walmart goes from 2% to 3%. Right now, it's around 2%, which is very low. That's getting really close to Costco's. Now we can compare the same profit margin to Target and see how it stacks up. We bring up the profit margin here, and Target's is at 5%, 4%. It's around double the profit margin of Walmart's. So Target is more expensive. It's objectively higher priced than Walmart or Costco. And during a time when the economy is slowing down, a company that charges more for its customers is likely going to take a hit. So it makes sense to me that Walmart's only down 2% this year, while Target's down 30%. A lot of investors are saying, look, if we're going into a recession like Jeff Bezos is predicting, then I'd rather own Walmart than Target. And I think that's a fair line of thought. What I'd say on the subject is between the two retailers, Target is selling at a 14 PE ratio. Walmart's currently selling at a 22 PE ratio. So in my opinion, this trade down from Target to Walmart is probably a little bit overdone. I think that Target right now, in my opinion, is a little bit better value. So my portfolio, I hold a little Target. It's been a great holding in the past. Even with this current sell-off, I'm up substantially in the company. And it may be the first time that I add a little bit more to this holding in over 3 years. If it continues to trade down, if people become overly bearish on it, I'll probably buy a little bit more Target. Now that's all for this episode. I hope you enjoyed, and I'll see you in the next one.